people are not going to fire sale their homes, and they don't have to.
So let's put our not your average investor lens on here, Keith, right? We're talking about all these data points and we're talking about all these things kind of in a vacuum, right? Like we are essentially saying that prices are not going to go down, right? Like, or at least we don't believe that they're going to go down. We believe that it's more likely that they stay stable or continue to go up. How should that inform kind of like a strategy based on, building a portfolio and trying to build wealth if you're thinking about investing in single family rental properties?
I think it's possible prices could drop a little, but not substantially. I largely agree with Lawrence Yoon on that one. The NAR expects 10% appreciation this year, 1% next year, and 5% in 2024. Take a good look at that there. And these future NAR numbers, they seem pretty reasonable, or else I wouldn't have shared them with you. We pivot to thinking about you as a real estate investor. It may be making a new purchase of a rental property today. I think it's important when you see all these articles in the major media talking about how it's such a bad time to buy a home because affordability's down and properties aren't moving and all that. All right, that matters. And a lot of that is true, but that matters for that primary residence buyer. So over here, we're remembering that when we buy a property, just call it a single family home that we're renting out to a resident, the tenant pays all of that interest for us when we buy a property where the rent income exceed all of the expenses, one of those being that mortgage. And you will pay more for a mortgage rate today, just like primary residence homeowners do. But of course, in the United States, like exceedingly few countries, you can refinance that down the road if you want to. This still impedes your profitability as a real estate investor to pay a higher mortgage interest rate. It is nice to know that the tenant takes care of that for you. That can limit your cash flow. It surely will. But I've asked other people still, could you invest in a better place today than residential real estate, where you buy in a market that has in-migration and job creation, where you have a tenant that's going to be able to pay that rent? And you touched on it earlier, Pablo. I invented that real estate pays 5 ways. I would still expect to get paid all 5 ways, 5 profit centers for real estate investors today, even in inflation and a potential recession. That's definitely some not your average investor stuff right there to get 5 simultaneous profit centers.
You are one of the guys that best describes the 5 profit centers, right? We talk a lot about it on the show. This idea that cash flow is only one of the profit centers, and it's kind of what mitigates against the risk of going too upside down and makes it scalable. The idea that your resident is paying down your debt, right? Like no matter how high that interest rate is, your resident's paying it down if you're in a cash flow positive scenario. The tax savings that you get, the appreciation that Jacksonville gets to, really benefit from being best in class of these cash flow markets of how high it is. And then there's inflation hedging. And we've gone back and forth on this idea that inflation is this thing that eats away at your spending power and your wealth. We have these 5 profit centers, but we are in this uniquely high inflationary environment. So can you describe to me kind of like the way that you like to describe inflation profiting when it comes to this asset class?
Real estate investors actually profit from inflation 3 ways at the same time. I think it's easiest to harken back to an example I used earlier. If you get a rent increase from $1,600 to $1,800, which is about commensurate with the rent increases that we've seen in the United States over the past year, that 12.5%. Well, if you had just $100 cash flow before you did that, so you had $100 cash flow when your rent was $1,600. All right. So let's say you rent $1,600 and your expenses are $1,500. That's your $100 in cash flow. When you increase that rent from $1,600 up to $1,800, that's only a $200 increase. But your cash flow just went up close to $200. So your cash flow, the money you feel in your pocket every month, just went from $100 to about $300. It's not quite $300 because you might have an increase in operating expenses as well. But you've just 2 to 3x'd the money that you feel in your pocket every single month. How did you do that off just a 12.5% rent increase? As long as you have a loan on the property, you as an investor, your principal and interest payment stays fixed. So you're profiting from inflation. Inflation cannot touch your mortgage principal and interest payment. That stays fixed.
Rents are going up for renters, but if you are owning as an investor and you're locked in, then inflation can't touch that thing and your rents are going to be going up. Therefore, you are profiting from that spread.
Yeah, and you bring up a good point. And this is one reason why the Fed doesn't like inflation, and a lot of people don't like inflation. It widens the disparity between the haves and the have-nots. And I just explained part of why. Inflation is going to do that. And you can be on either side of it. You could be a renter where you're at the mercy of rent increases in high inflation, or you could be that property owner that actually benefits from the high inflation. I mean, we're seeing the separation in classes right there. Like, where does that happen? How does that happen in high inflation? That's exactly how it happens.